This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Today on the show, I have Eric Crittenden. Eric is with Longboard Asset Management. Eric has appeared on my podcast before. He is also featured in my book, The Little Book of Trading. Today, we talk about a white paper, a research paper, that he originally put out in 2005 with his partner, Cole Wilcox. It's been updated many times, but worthy of discussion. The topic, trend following on stocks. I hope you enjoy. I think our narrow focus tonight, morning for you, is probably a smart place to go, and which is trend following on stocks. And I still remember it. You'll have to correct me on the year. I want to say 2005. When you first you and Cole put out the paper, Does Trend Following Work on Stocks? And to some degree, I think you were out on an island at the time. It wasn't a common conversation in the strategy of trend following to be applying it to equities. Very well known in futures at the time, but not something applicable to equities. What spurred you on to do that research, to write that at that moment in time? And why don't you fill in the year for me when you first put it out? I know there have been several, not revisions, but several kind of adds to it and expanding it over the years, but...
Yeah, if I remember correctly, we originally sat down and started to write that paper at the end of 2004. I do believe it was published in early 2005 initially. What motivated us, at the time, Cole and I were managing a fund of funds that allocated to systematic trend followers. So we were constantly meeting new commodity trading advisors and flying around the country, or he was flying anyways, doing our due diligence on trend followers. And we thought it was peculiar that we couldn't find anyone who was applying trend following approaches to individual common stocks, with the exception of just a couple of firms that were doing limited trend following on stocks. It was not something that was popular. It was not something that was in development, and it was perplexing to us. And frankly, it made us a little bit skeptical about the industry as a whole, because from our perspective, Cole and I both had equities trading backgrounds. We saw the fat tails in stock returns, both long and short. We saw the degree to which individual stocks, a very small minority of individual stocks, drove the overall stock market's returns each and every year. And intuitively, we thought, well, trend following would be a great approach to try to source some alpha out of this. So we were perplexed that we couldn't find CTAs exploiting what we felt was a good business opportunity. So we began, and this was back in 2003 that we made these observations. So we began a 2-year research project by which we collected data on all of the stocks that ever traded in the United States. And our research indicated that trend following likely would work great on individual stocks. So that paper was basically a summation of our research findings. It was, a generic long-term trend following approach, relatively simple, applied to all of the stocks that were ever in the Russell 3000 from the 1980s until the current date at the time, which was 2005. And it appeared pretty conclusive that trend following would be a viable approach on stocks. So we wrote the paper, I think, to one, establish some credibility, get it out there, and perhaps even over time attract like-minded people, be they clients or collaborators.
What do you think, as you were investigating this, you're curious, you start to do the research, the homework, you're digging in, whether it was just anecdotal or not, what did you start to think was the reason why other more established players were not doing this on equities, or at least for public consumption?
It's a good question. There's a couple of things that we realized. One has to do with regulatory constraints. The futures world and the equities world used to be very, very separate. And only recently have you seen some merging of the two. So when we talked with people who were experienced at trading futures and forward contracts, they had strikingly little understanding of equities, the issues with respect to the data. They weren't used to dealing with a universe size of 50,000 stocks. Their software and systems were designed to track 100 futures contracts. They didn't understand how to adjust for corporate actions like spin-offs and mergers and dividends and distributions and things of that nature. So they just didn't have a lot of experience or incentive to enter the quagmire that is equities historical data. So that's one thing that I believe motivated them to just stick with what they were doing, which at the time was working well. They didn't have a lot of incentive or motivation to diversify into equities. The other one was the CTAs that we did talk to that had dabbled in equities a little bit tended to come to different conclusions than we did. They were less impressed with the effectiveness of trend following systems on stocks. And upon further review, after talking with them, most of that was a function of the fact that they didn't know how to deal with the data, and they weren't correctly adjusting for things like survivorship bias and post-dictive error as they apply to equities data. So these are minor issues if you're experienced and you've been through it, but they're daunting at first because you have to come out of your comfort zone and think like a database developer and look at the data and ask yourself, does it really represent reality, or do I have to go back and reconstruct this from the ground up? And the answer is you have to go back and reconstruct it from the ground up. So today is a different story. We see established firms like TransTrend and Winton and AHL and these others introducing trend following on equities programs. And some of these firms have gone so far as to take a big chunk of their flagship program and dedicate it to trend following on equities. So there has been a sea change in the industry.
As we're establishing here, there's been so much trend following in the futures space, but I'm thinking back to the first time, and I think it was some writing or some research. I have to go find it, but I believe Richard Donchian's first application of trend following strategy was on equities, and that he went to futures after equities initially. But then there was like this as you and I are describing, here's this long kind of in the wilderness where people were just fixated on one particular type of instrument. And as you say now, there's more of a diversification mindset.
Right. Yes.
I know you guys have done a couple different iterations, revisions, but your updated research on your paper that has become well known for people that follow this type of work, your updated paper for Does Trend Following Work on Stocks, you guys have been applying for the last 7 or 8 years this type of thinking to the markets, correct?
Yes, that's correct.
Tell me. I think the classic example that I think anyone that's listening to your prior interview, I can't remember if you and I talked about it, or Cole's interview. I think people, and I saw someone post this on my Facebook, Tesla.
Tesla's one good example out of thousands, though. We have been doing this in real time since January of 2005. So I know I've been getting up at 4:30 in the morning every day for a lot of years now to come to the office to run the daily operations for trend following on stocks and in other instruments now. So I would say that over the last 7 to 8 years, well, first of all, we couldn't have picked a better time to stress test an approach on out-of-sample data. I mean, just think about what we've experienced in the equity markets over the last 7 to 8 years. We began in 2005 with a very narrow bull market, and then the cascading catastrophic bear market that really started in 2007, but it showed up in the indexes in 2008. And then since then, we've had this unprecedented bull market where the historical norms just don't seem to apply. So again, that's a pretty good out-of-sample stress test for a trend-following system. And I would say that our long-term trend-following approach has been very resilient on this out-of-sample data. It's experienced a very good compounded annual growth rate. It's had reasonably low volatility and excellent downside risk control. So I guess I would just say that it's done exactly what it was designed to do, and we haven't had any nasty surprises. So I'm content.
Let me circle back, not to push hard on the one name that I just dropped on you, but more as an example, an illustration, because it was a conversation that Cole and I had. And if we were to talk about Tesla not as an opportunity for anybody, but just kind of an educational rip through, and like you said, we could probably insert many, many different names that take the same price data formation that Tesla has had. There's nothing unique about it. And I know your personality, and I know Cole's personality. You are very much a research systems guy. So I know, frankly, I'm guessing, and you could correct me if I'm wrong, the idea of the business model necessarily of Tesla could be interesting to you, but I have a feeling it's the research and how your models and systems apply to a data stream, like an example using Tesla, is what really interests you.
It is, yes. I'm not interested in individual names. We've made far more money on hundreds of other stocks than we have on Tesla. Tesla is just one. It's the high-profile name, and Cole has, had a large position in Tesla during this. Sometimes he runs a discretionary trend program where it's basically the same approach. He just concentrates in fewer names that have some contrarian sentiment type inputs that he utilizes pretty successfully on what he does. But Tesla hasn't done anything that the other 1,624 stocks in the portfolio didn't do. It hit a new multi-year high. We initiate a long position. We have a trailing stop that's a volatility multiple. It's about 10 standard deviations below the entry price. Our estimated risk is the distance between that breakout price and that stop loss, and we size our position such that it has the same risk as every other position in the portfolio, and we control the total open risk in the portfolio, and then we rinse and repeat and stay disciplined and continue that process every single day, and that's what we do. And Tesla is just one of 1,600 stocks in the portfolio.
Yeah, I wanted to circle back and just make sure I clarify, because it's the sexy name that's out there, it's in the news and that kind of thing. But like I said, I know your personality. You are in the research, and I know it's sexy is not something that you wake up each morning and really care about.
No, and in fact, our style of trend following, at least in the systematic program that I run every day. Trend following actually makes more money on the lesser known names because they have lower volatility, and therefore the stop loss level is generally closer and the position sizing is higher. So our trend following approach actually prefers low beta, low volatility, dividend yielding stocks. On a total return basis, those instruments, at least from what I've seen over the years, tend to trend much more nicely than the more volatile growth stocks.
Do you see anything on the horizon that takes trend following on equities in a suboptimal direction? Not to sound too academic, meaning, is there something you see that could change? Are we in a unique 10-year, 15-year period? Or, and I'm guessing this is your thought process here, and you correct me if I'm wrong too, but I'm guessing this is what your original thought process was, is that, look, hold on, human nature is human nature. We have these strategies human nature applies to all different types of instruments and markets. It should work here. How do you see trend following on equities going forward in the future?
I don't think that the future should be any different from the different versions of the past that we've had. We've had the 1920s, the 1930s, the 40s, 50s, and every subsequent decade after that. And each one of them has a different flavor, but they basically fit into one of 4 or 5 different molds. And trend following prefers certain market environments to others. I'd say the worst case scenario is a narrow market, kind of like what we experienced in 1998 or in 2007. And the reason that I say that's the worst is for our style, which tends to calibrate our risk as a function of the scope of the portfolio, meaning that if we have a lot of diversified trends and not a lot of extreme volatility in the market, well, then we can get a lot of positions on, and the position sizes can be large, which means that we have a lot of exposure and we can make very high rates of return. But if the inside of the market is deteriorating and the breadth is breaking down and the volatility is high, well, then in order to control our risk, we have to adjust our position sizes down, and we'll have a more narrow portfolio. We'll have less holdings and less diversification. And in that kind of environment, our appetite for risk is lower, and that means that our expected return is going to be lower. That is not the kind of environment we're in. We've been in a very broad-based, low volatility bull market for a couple of years now, and this is one of the most prolific runs that trend following on equities, according to my research, has ever had. So I'm not going to complain about the current market environment.
Well, when you say that, curious though, when you say prolific run, we know what happens after prolific runs, and sometimes there's other strategies out there like buy and hold, for example, or long only, that don't prepare for the inevitable go the other direction. And I'm surely not going to sit here with you and attempt to have any kind of guessing game about when an overall equity direction might change. That's not the point. But I think the point is to realize that things do change, and they will change at some stage of the game.
Well, absolutely, and that's why we have a trend following system that has a total portfolio level risk constraint that's a function of all those stop losses. Because, like you said, there is no way to know when the party's going to be over and when we're going to go into a structural bear market. A lot of the movement that we see in the markets today is very political, a risk on, risk off kind of environment. Fortunes are made and lost based upon the whim of decisions made by politicians who don't know what they're going to do when they get the data, and they don't know what the data is yet. So let's be honest, we don't have any way to predict whether the stock market's going to go up next year, next week, or tomorrow morning. So the best we can do is control our risk and react to changes in the market and stay disciplined and repeat that process over.
Your work, your research, your trading, all price-driven, all systematic?
Yes and yes.
I have seen one of the, and I mentioned this on a recent podcast, I've seen that one of the largest hedge fund managers in the world, if not the largest, has said that he's 100% systematic but uses no technical information. So are you using, it's purely price-driven, that's it?
Right. We look at the date, the open, the high, the low, the close, and the volume, and that's it.
And systematic in the sense that you set your rules down, they're codified, it's all codified, and you are not sitting there as the captain of the ship wearing, at a Star Trek command base ready to override something on a daily basis based on how you might feel at that moment.
Absolutely not. There is some human judgment involved, and I'll tell you about that. My job is to come in every morning before the sun comes up and to make sure that the rules that we all agreed on and that we have discussed with our clients are being implemented, and that the combination of the computer and the data provider and the software and the broker, everyone's doing what they're supposed to be doing. So it's a rare event that there's a problem, but it does happen. And it could be a data issue. It could be a missed stock split. It could be a dividend that didn't get processed correctly. The broker could have made a mistake. Something could go wrong with the software. And I've been doing it long enough such that when I sit down and look at the equity run in the trade blotter, I know instantly if something doesn't make sense. And then it usually takes me about somewhere between 5 minutes and 20 minutes to track down the source of the error. And that happens about once or twice a year. That's my job. And then to reconcile the trades and to just make sure that the program is doing what it was designed to do.
Why does this work? Because the Nobel Committee just gave a prize to Eugene Fama. He says the markets are efficient. You and I are having a conversation essentially about inefficiency. So why does this work? What's the source of the return here? Why is this happening? Why is Eric Longboard making money this way?
Well, we have to revisit the answer that you gave me at the beginning of this conversation, and that is
Don't put me on the spot. I don't know what I said.
Well, you said there's a long answer to a short question.
Okay.
So I will say there's a very long answer to a medium question. There's several things going on at the same time. One has to do with the definition of efficient. You ask 10 different academics exactly what they mean. They'll give you 10 slightly different answers. Markets might be efficient. I mean, they're always striving to become more efficient, right? But efficient at what? Why does a market exist? Its whole job is to bring buyers and sellers together. Its whole job is to move the price to where it needs to be to facilitate either risk transfer or capital formation, right? And as long as you don't have too much overregulation or too much taxation, well, the markets are actually pretty efficient at bringing buyers and sellers together at a price that they can both agree on. So I would say in that sense, markets are pretty efficient, right? When people say you can't beat the stock market because it is efficient, what they're really saying is you can't beat the S&P 500 because your system's not better than the S&P 500. That's what they're really saying. So, and let's talk for a minute about what the S&P 500 is.
It's a system, essentially.
All it is a brute force, naive trend following system that adheres to a market cap weighted position sizing scheme. That's all it does. It's a trend following system. It's just a big, brutish trend following system. So it has no form of risk control. It's very susceptible to variance drain, meaning that it can have 50% drawdowns, and then it'll rebalance. And then after that, you need to make a 100% return on your new positions just to get back to break even. So there's a lot of downside risk in that. So when people say the market's efficient, therefore you can't beat it, that's probably a true statement for most people that stay 100% fully invested at all times. Because if you do that, you're going up against the S&P 500, which is a trend following system, and it's a very aggressive trend following system. So for most mutual fund managers or asset managers, they're going to pay fees. There's going to be fees involved. There's going to be transaction costs involved, and they have to beat a pretty aggressive trend following system that has no fees and has very limited turnover and transaction costs. So that's difficult to do if you remain 100% fully invested all the time. Now, trend following is generally a misunderstood strategy when it's applied to equities. People tend to just focus on the entries and the exit rules. But if you were to seriously audit our results or anyone else's trend following on equities and try to figure out why they made market-beating returns, what you'll find out is that the exposure management is actually more important than the entries and the exits themselves. What I've noticed over the years is that professional trend followers almost always learn to adjust their exposure in a way that's responsive to changing market conditions. In practice, what you'll find is they often have low exposure in high risk or high volatility environments and they'll tend to have greater exposure in low risk or low volatility environments. So now we're talking about leverage. So our particular approach, which attempts to have a certain level of risk at the portfolio level and to take every trade, to buy every single stock that breaks out, and to stop out of positions that fall by a statistically significant amount. If you merge all of that stuff together, what you'll find is that we use leverage in low volatility market environments. And that we'll do the opposite of that in high volatility market environments. We'll hold a cash balance. And over time, like in the current environment where we've had a low volatility, broad-based bull market for years now, we've been using quite a bit of leverage for a long period of time. And a lot of our outperformance comes from the use of leverage. So I would say about 70% of it comes from the judicial use or non-use of leverage, and about a third of it comes from the actual stock selection component itself. That's a bit counterintuitive. In some people, that doesn't excite them, but the judicial use and non-use of leverage isn't possible if you don't have a trend following system, because without the trend following system, you can't estimate the amount of risk you're taking. Does that make sense?
I think absolutely. And I think it's a fantastic explanation. I think people are going to listen to this conversation tonight and they're going to really say, wow, Professor Critenden just helped me out there.
Well, the same can be said in the futures world too. We look at things very differently. We're very skeptical people, very conservative, and we always invert. Like Charlie Munger says, always invert the question before you waste too much time trying to answer it. So we don't assume that trend followers make money because of some magic algorithm that predicts when the market's going to go on a run to the up or the downside. It could be from something else. It could be indirectly through proper position sizing and exposure management. In fact, I strongly feel that that's the case.
What is a fascinating topic? Both of us have been in this world for quite a while. It's just fascinating, and I think sometimes I feel like my role is to help spread the gospel, so to speak, but I don't know if that's my role anymore because, to some degree, you and I know this. There's a certain segment of the population does not want to hear any of this conversation, is not paying attention. I think it's on the margins we're winning converts. I don't know. Maybe you'll disagree with me, but I don't know if there's going to ever be a massive tidal wave of new converts to this way of thinking. I think there's so much emotional and psychological baggage that goes with being as brutally practical as you've been in this conversation. I don't know if it's something that majorities can handle.
It's not, and I think that's important because that's why it works. At the end of the day, this is a zero-sum game. The alpha component anyways. It's actually negative sum because the commissions, slippage, taxes, regulatory fees. So it's not really possible for the majority to get ahead and be above average. That's not mathematically possible. So I'm not worried about having a large number of converts. We don't want that in the industry. It won't work.
Well, not only do you not want it, but I think it's practically impossible is really, I think, what we're both saying. It's just there's a lot of reasons why it's impossible. I don't think we're going to have those converts.
What's fascinating to me is just how counterintuitive and contrarian trend following really is. I meet a lot of investment advisors, and I've actually been, somewhat impressed with their open-mindedness and willingness to consider something that initially doesn't make a lot of sense to them. I think market environment has a lot to do with that. But trend following in practice is very contrarian, especially at those key inflection points. Like if you were to go back to when gold first started to go up in 2002, and it entered a very meaningful, obvious uptrend, but it was met with such apathy and skepticism by virtually all investors. I remember at the time trying to get people interested in buying gold back then, and people actually got violent with me. It was such a ludicrous idea to them. And it wasn't just gold, it was copper, it was silver, it was the euro, it was bonds. There was all kinds of trends changing, significant paradigm shift going on back then. And the hostility towards any of these new trends really stuck with me. And I'm noticing the same thing now, but it's the opposite. right? Gold has entered a downtrend. Some of the emerging markets have entered a downtrend. A lot of the emerging market currencies have entered downtrends. There's a whole bunch of new trends that just got started in the past 6 months that are being met with apathy and skepticism. And it's just a repeat, in my opinion, of what I've seen before. And it kind of drives home the point that as a trend follower, you can't be comfortable with consensus. You have to be willing and happy to maintain discipline and to go with those trends, and don't seek comfort in numbers.
Numbers, and you mean specifically other investors, their opinions, their advisors, and that cacophony of constant information that every one of these little devices that we all walk around with on a daily basis, it stays attached to our hip, is to kind of block that out, because that's the stuff that doesn't help.
Everything you just said is 100% true, in my opinion.
Yeah, distraction is I think that's probably and I think people could probably hear it in your personality, very pragmatic. And so I'm guessing that you've developed techniques throughout your career to help block out distraction. Before you even get into the part of trend following research, trend following trading, you had to have a certain way of acting, thinking, working where you could block out.
Exactly true. I did that way back when I was in college. I haven't watched a television since 1996. No newspapers, none of that stuff. And my productivity is 10 times higher than it would be if I was inundated in all of the regurgitation of last quarter's information. And I'm not begrudging people their information or their socialization or whatnot. It's just not for me. And I don't think it's for anyone. You need someone like that to be running the actual day-to-day operations, in my opinion. Someone who's clear of mind, has one focus. And I don't mean to suggest that person needs to be closed-minded. That person actually needs to be very open-minded and very humble. But they don't need to be constantly inundated with information that is outside the scope of what we've agreed to is important for making good business decisions.
I think the practicality in our conversation today will be the takeaway for people. I enjoy having you on, as always, Eric. Hey, what's the best place if people want to go that have not yet seen it, your Does Trend Following Work on Stocks research paper, the best place to go check that out and to find out more information on you and your firm?
Well, the best place to download any of the research papers that we published over the years is your website, trendfollowing.com. The best place to learn about Longboard is our website, which is longboard-am.com. I was just going to say that stands for longboard-assetmanagement.com. It's just abbreviated. And there you'll find a whole bunch of stuff about the firm, the principles, what we do for a living, stuff like that.
Like I said, Eric, I always appreciate it. Great conversation. When I will be to the West Coast in January sometime, maybe I'll skip over to Arizona and say hi.
Yeah, come on over to Phoenix. It's a lovely time of year to do that. Are you still in San Diego?
I'm going to visit some friends there. I don't think I'm going to be living there. I'm probably going to be taking a trek back to Asia. So,
yeah, if you can, stop by. I'd like to show you the new office, give you the tour, and introduce you to the staff.
That'd be great. Hey, Eric, I appreciate it, and we will talk again in the future.
Great. Thanks, Mike. Have a good day.
Take care.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, Trend Following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.